My dear friends, welcome back. Today, I want to take you inside the most important concept in all of intelligent investing, the idea that separates speculation from discipline, noise from truth, and hope from actual financial judgment. It is the concept I relied on throughout my entire career, the principle that shaped every decision I made, and the framework I wish every investor truly understood: intrinsic value. Now, you may have heard this term many times, repeated casually in investment conversations, tossed around by analysts, or simplified in textbooks. But what most people call intrinsic value is merely a guess, a projection wrapped in confidence. What I want to show you is something far deeper, something practical, something grounded, something that has protected investors for nearly a century. Let me begin with a question. If the stock market closed tomorrow and stayed closed for 5 years, what would this business be worth to you as an owner? That question, my dear friends, is intrinsic value. It is the worth of a business based on its ability to produce cash for its owners, not based on market emotion, price movement, predictions, or headlines. But before we touch the calculations, I want to tell you a short story. In my early years, I analyzed a company whose stock price fluctuated wildly, soaring on excitement, collapsing on fear, rising again on rumors. Every investor around me was obsessed with the movement. But I noticed something. The company's factory, employees, customers, and earning power were exactly the same, whether the stock traded at $15 or $50. It was that moment I realized the market's opinion changes every day, but reality changes very slowly. Intrinsic value is simply the attempt to measure reality. Let me give you a definition: clear, simple, and timeless. Intrinsic value is the present worth of all future cash the business will generate, discounted back to today, using conservative assumptions, not optimistic assumptions, not best-case scenarios, not heroic forecasts, conservative assumptions, because the goal is not precision, the goal is protection. If you take away only one sentence from this lesson, let it be this: intrinsic value is not about knowing the future. It is about refusing to lie to yourself in the present. Now, why does intrinsic value matter so profoundly after 2025? Because your world is faster, louder, and more emotional than mine ever was. Artificial intelligence accelerates information. Social media amplifies fear and excitement. Prices move not because businesses change, but because opinions change. And amid that noise, investors lose their anchor. Intrinsic value is that anchor. It allows you to stand still while everyone else is swept away by emotion. It allows you to see clarity where others see chaos. And it gives you the confidence to act when opportunities appear, and the discipline to walk away when prices become foolish. Over the next few minutes, I will take you through a complete framework: how to break a business into its essential components, how to determine earning power, how to apply a rational discount rate, how to build conservative estimates without guessing, how to identify when the market price disconnects from reality, and how to use intrinsic value to protect yourself from emotional mistakes. I want you to treat this lesson as a masterclass, not in mathematics, but in judgment. Because intrinsic value is not merely a number, it is a mindset, a way of seeing the world as it is, not as the market wants you to see it. Let us begin. Now, my dear friends, before we compute anything, we must learn to see a business the way a true investor sees it, not as a fluctuating stock price, but as a living economic engine. Intrinsic value is nothing more than the attempt to understand that engine honestly, conservatively, and without emotional interference. There are three pillars that support intrinsic value. If one of them is weak, the entire structure becomes unreliable. So let us examine them one by one. Pillar 1. The present strength of the business, foundation value. Before you think about the future, you must understand the present. This begins with the balance sheet, the one financial document that does not lie easily. I never begin with forecasts. I begin with what exists today. Ask yourself, if this business stopped operating tomorrow, what assets would remain and what obligations would survive? This gives you what I once called the net asset value, or net current asset value in extreme cases. Most investors skip this step because it feels too simple, too boring, too slow. But simplicity is wisdom in disguise. A company with a weak foundation rarely becomes a strong investment. A company with a conservative balance sheet, on the other hand, can survive storms that destroy its competitors. And after 2025, storms will come quickly. Technological shocks, interest rate shocks, investor sentiment shocks. The balance sheet tells you which companies can endure. Think of it as the bedrock beneath the building. If the bedrock crumbles, the height of the building does not matter. Pillar 2. Earning power, the heart of intrinsic value. Once the foundation is understood, we move to the second pillar, earning power. This is the heartbeat of the business, its true economic engine. But my friends, beware of recent profits. They're seductive, but unreliable. A single strong year can create illusions. A single weak year can create fear. So what do? We normalize. Normalization means stepping back and asking, over the last 5 to 10 years, what level of earnings reflects this company's real, sustainable performance? Remove the spikes. Remove the anomalies. Remove the lucky contracts and the temporary disappointments. You are looking for the steady rhythm underneath the noise. A business may report $500 million in earnings one year and $300 million the next. The question is not why did earnings fall, but what is the typical, repeatable earning power of this company? That number, not the headline number, forms the core of intrinsic value. Let me offer you a quiet truth I learned early in my career. Investors lose fortunes by overestimating growth, but they rarely lose by underestimating it. This is why intrinsic value insists on conservative assumptions, not pessimistic, simply realistic. Optimistic numbers create fragile valuations. Conservative numbers create durable ones. Pillar 3. The discount rate. The psychology of uncertainty. The third pillar is the most misunderstood, and yet it is the one that reveals the emotional maturity of the investor, the discount rate. You see, intrinsic value does not merely measure what a company earns. It asks, what return must I demand to justify owning this business given its risks? Most investors think the discount rate is a mathematical constant. It is not. It is a reflection of uncertainty, durability, industry stability, and your willingness to tolerate the unknown. If a company is unpredictable, cyclical, heavily indebted, or exposed to rapid technological shifts, you must demand a higher discount rate, meaning you value its earnings less. If a company is stable, essential, conservatively financed, and historically resilient, you may accept a lower discount rate, meaning you value its earnings more. But here's the danger. If you choose a discount rate that is too low, you are lying to yourself. You are pretending the future is safer than it really is. After 2025, the world will tempt investors to underestimate risk. New technologies will appear irresistible. New industries will look invincible. New narratives will feel inevitable. But intrinsic value is not interested in stories. It is interested in safety margins. Choose your discount rate with humility, not optimism. Now that we have the three pillars, foundation value, earning power, and the discount rate, we can begin assembling them into a practical working model of intrinsic value. In the next section, I will show you the real process I used. A simple, rational framework for estimating a business's worth without falling into the traps of forecasting or speculation. Let us continue. Now, my dear friends, let us take these three pillars, the balance sheet, earning power, and the discount rate, and assemble them into a practical framework. Remember, intrinsic value is not a prophecy. It is a discipline, an anchor, a tool that allows you to make calm decisions in a world addicted to noise. Let us walk through the process step by step. Step 1. Start with what you know, never with what you hope. Most investors begin with forecasts. This is a mistake. Forecasts are fragile because they depend on what the investor wants to be true. We start with what already exists. Revenues, margins, costs, cash, reserves, debt levels, historical earnings. These numbers are not opinions, they are facts, and facts are the only honest foundation for intrinsic value. If a business cannot justify its value through its present reality, no imagined future will save it. Step 2. Estimate normalized earnings, the real engine of value. To determine earning power, we eliminate noise. Look at the last 5 to 10 years and ask, what would this business earn in a typical stable year? This removes pandemic spikes, unusually good contracts, temporary setbacks, speculative expansions, one-time write-offs. Normalization does not require advanced mathematics. It requires humility. You are not trying to guess what the business could earn under perfect conditions. You are asking what it will likely earn under ordinary conditions. This is the number that matters because intrinsic value is built on consistency, not miracles. Step 3. Apply a rational multiple, the practical discount rate. Once you estimate normalized earnings, the next question becomes, how much am I willing to pay for each dollar of earnings? This is where many investors fall into fantasy. They choose multiples that reflect hope rather than risk. Instead, choose a range that reflects uncertainty. A stable, essential business might justify a multiple of 12 to 15. A cyclical or competitive business might deserve only 8 to 10. A highly unpredictable business may require an even lower multiple. A multiple is nothing more than a discount rate turned inside out. It expresses the return you demand for taking on risk. If the business is risky, the multiple must be low, because risk and price cannot both be high. This single rule protects more investors than any formula ever invented. Step 4. Compare value to price, where judgment meets opportunity. Intrinsic value becomes powerful the moment you compare it to market price. If intrinsic value is far below market price, you walk away. No matter how exciting the story, no matter how persuasive the analysts, no matter how loud the crowd becomes. If the price is too high, the risk is too high. On the other hand, if intrinsic value is comfortably above market price, even after conservative assumptions, then you have found something rare, a margin of safety. This margin is the oxygen of investing. It allows you to breathe through volatility, uncertainty, and fear. It gives you the psychological advantage that the market does not have. A bargain is not when you hope the price will rise. A bargain is when the value is already greater than the price. Step 5. Resist temptation. The hardest step of all. Intrinsic value is simple to calculate, but simple does not mean easy. The real challenge is emotional. The crowd will tempt you to abandon your discipline. The news will tempt you to react impulsively. Hot stocks will tempt you to chase. Fear will tempt you to sell too soon. The investor who masters intrinsic value must also master himself, because intrinsic value is not a number on a page. It is a commitment to truth over emotion. Now, in the final part of our lesson, I will show you how intrinsic value becomes a living philosophy, how it protects your wealth, shapes your identity as an investor, and guides your decisions through every cycle, especially in the unpredictable years beyond 2025. Let us continue. The underlying earning power deteriorated, or have emotions simply taken over? If the business is still intact, a falling price is not a threat. It is an opportunity. This is the advantage of intrinsic value. It turns market chaos into clarity. Intrinsic value shapes identity. Now I want to reveal the deepest insight I learned over decades of investing. Intrinsic value does not only protect your portfolio, it shapes the kind of investor you become. When you think in terms of intrinsic value, you stop chasing the market. You stop fearing downturns. You stop relying on predictions. You stop needing permission from others. You begin trusting your own analysis. You begin valuing patience over excitement. You begin developing what I called a sound intellectual framework. And once you adopt this identity, the identity of a rational, independent investor, you no longer behave like the crowd. You rise above it. The crowd reacts. You reflect. The crowd speculates. You evaluate. The crowd moves emotionally. You move deliberately. My dear friends, this identity, not the formula, is what will build your wealth after 2025. The world will become louder. You must become quieter. In your modern world, technology accelerates everything. Information predictions, panic, hype, algorithms. Noise has become permanent. Volatility has become normal. But the principles of intrinsic value have not changed for a century, and they will not change for the next century, because these principles are rooted in something deeper than markets: human behavior. People will always overreact. People will always chase stories. People will always confuse price with value. And because human behavior does not change, the investor who understands intrinsic value will always have an advantage. You do not need perfect knowledge. You do not need complex models. You do not need to predict the future. You only need a rational estimate of earning power, a conservative discount rate, a margin of safety, the patience to wait, the courage to act. Everything else is noise. Final message. As we conclude this masterclass, let me leave you with one enduring truth, a truth I carried throughout my career. The market is never your master. It is your servant. It offers you prices. You decide whether to accept them. Intrinsic value gives you the confidence to say no when everyone else is saying yes, and the courage to say yes when everyone else is saying no. Thank you for spending this time with me. In our next lesson, we will continue building the foundation of intelligent, behaviorally resilient investing. Until then, stay patient, stay rational, and always insist on your margin of safety.